The semiconductor space has seen a lot of losses recently. This week, Nvidia has really been dropping and it's bringing down the whole space. At some point, some of these semiconductor stocks are going to begin to look like really good buys. And I wanted to focus on Qualcomm. Qualcomm is a semiconductor company really focused on communications. If you go back to the origination of mobile phones, Qualcomm was a player, and they've been a player ever since. When it goes to wireless communication, Qualcomm's a leader. They also have a lot of revenues from the Defense Department because a lot of their technologies are used by the military. They're a company that is headquartered in San Diego, and I've known of this company for a long time. Looking at the company's stock, the stock has gone up over time. If you've held the stock for 5 years, you're up 109%. But it's not the really incredible rises that you've seen in Nvidia or like Broadcom, which I believe are a little too frothy at this point. It has a market cap that's quite reasonable at $184 billion, and they do pay a 2% dividend, which is nice. And Qualcomm provides opportunities to buy the stock at a reasonable price. Less than a year ago, Qualcomm could have been bought for about $100 to $120 per share and really seen a nice increase in the stock price. I did so and I made a fair amount of gain from the stock. I'll show those results to you a little later. But recently, the stock's really come down. It's down 23% from its high. And that's why it leads me to really analyze the company and see if it's a good buy. Let's take a closer look. So the company has revenues of $37 billion, really big company. The PE is 21 in the current year, but it's supposed to drop to 15. They're really growing their business nicely, and I'll show that in the income statement in a bit. Analysts believe that it's a good buy and it's discounted by 24%. That's interesting. When I look at their financials, and I'm going to zoom in on the quarterly, the most previously closed quarter, they're growing the revenue by 11%. That's really good growth. You can see that it's really picked up. The growth has accelerated. And that in prior quarters, they weren't growing, which is normal in the semiconductor space. Semiconductor companies are cyclical. They have a couple of good years, maybe a bad year, or maybe couple bad years. As companies buy those semiconductors and put them into service, they don't need to replenish for a while. Therefore, Qualcomm had a couple bad years, but now they're beginning to have a nice run up on revenue. So it's a good time to look at the company. When we look at cash flow, really impressive how this company has really grown their free cash flow. They've always been a good positive generating cash flow company, but the trailing 12 months, the cash flow has increased to $12.5 billion. That's really good. So I'll use the free cash flows as part of my valuation of Qualcomm. Looking at what analysts believe about the company, there's 24 analysts that look at Qualcomm, and they all believe on average that it's discounted by 24%. They expect that in 2024, the company is going to produce $10.28 in earnings per share, which is a big growth from prior year. You can see that bad year in 23. Then after 24, it's going to grow at a good rate of 10% and then almost 9% in 2026. So really the next couple of years look good for Qualcomm. I'll use this information in my valuation of Qualcomm. To dig a little deeper, I wanted to go into the financial statements and point a few things out that are important for me to look at in this semiconductor company. So the growth is excellent, which is very good. I wanted to hone in on the balance sheet. Semiconductor companies carry an inventory, and it tells you quite a bit. It went from 6.4 billion to 6 billion. So that's a decrease of 400 million. And what that tells me is that their growth has accelerated and they've depleted their inventory, which is good. I don't like seeing semiconductor companies really swell up their inventory because it goes to show that customers aren't buying, and it's becoming risky to carry that type of inventory where it just kind of gets cash gets stuck in inventory and potentially they have to write off that inventory. So it's good to see that inventory is decreasing. Overall, their cash flows are really good, and it's really a product of a couple of factors, one of them being a big tax benefit. It looks like they had a provision for tax that's not a non-cash item, so they were able to add it back and put it into their statement of cash flows. That was the biggest effect there. But they've done other things like their accounts payables being managed well Inventories went down again. That's a positive. I like that. So overall, the statement of cash flows looked really good for Qualcomm. To make a decision on a stock, I run my own calculations of what I think the stock is worth. And I'm going to do that for Qualcomm, looking at their free cash flows and also looking at their earnings per share. Looking at cash flows first, I'm going to be conservative and start with last year, just add 10%. And it gets me to $10.8 billion in cash flow that I would expect. They're running at a faster pace, but I want to have a forecast that's reasonable and a little bit conservative. I'm going to grow cash flows in the first 4 years by 6%, and the terminal value beyond year 4 is $298 billion, which grows at 4%. I'm going to have a discount rate of 8.5. Interest rates are dropping, so again, that's a conservative number. I could have gone with 8, which would have given us a higher valuation. The net present value of all those free cash flows is $236 billion. I'm going to add the cash on the balance sheet and take away debt. The equity value is $235 billion. The market cap of the company is only $182 billion. So there's a discount of 28% if I look at the cash flows the company produces, which is very good. The earnings per share expected are $10.28. I'll use a PE of 18 and a growth rate of 6%, which gives me a value per share of $196 per share. But shares are being sold for $165. So there's a 19% discount using earnings per share. So my blended discount, where I blend free cash flow and intrinsic value, earnings per share value, comes in at 25%, which is similar to where analysts put this stock. So I have high regard for Qualcomm. And now I'm going to tell you about the desirability of the company and then make a decision on whether I should buy shares of Qualcomm or pass. So I've put together a desirability quadrant, and just to basically establish how desirable a company is to me. And the most desirable companies are in the green. These are companies with really strong moats, barriers of entry against their competitors. These are monopoly like companies that have high revenue growth, high profitability, and generate high free cash flows. And in the gray are companies that are good companies, but they don't quite have that monopoly like business. In the red are companies that just have too much competition. They can't grow. Maybe their space is contracting. Their industry keeps getting smaller and smaller. Profits are pretty thin. Cash flows are non-existent. Companies in the red I try to avoid. Now, Qualcomm isn't quite completely in a monopoly-like business. They do have patents. They do have really good business with, especially with the government around the Department of Defense. So I really like Qualcomm, and I'm going to have them straddle between gray and green. And I put them in green because they do have some technologies that are very unique to them, especially with the military, where they've put a lot of their semiconductors into the military complex. And some of their wireless chips are quite unique. They're really making noise now in the PC market with their Snapdragon chips that are going to be good chips for AI. So overall, I like the company. They straddle both gray and green, and it's a desirable company to me. Since they are providing a nice discount on a high quality company, I'm going to be buying shares of Qualcomm. Today, the stock's trading down a bit in the pre-market hours. So if the stock is being priced at a discount, meaning less than it was priced at the close of the market yesterday, I'll buy some shares. I'll probably start with $1,000 and then dollar cost average from there. I could see myself buying $25,000 to $50,000 of Qualcomm when it's all said and done over time. Now, let me show you my prior investment in Qualcomm because I've been in and out of the stock, and the last occasion was really successful. So I invested in Qualcomm in 2024, and I started buying shares at the very beginning of the year, and I dollar cost averaged my investment. So I bought over time, and then I decided to sell when the stock price just got way too high, well above the value that I had for Qualcomm. I invested $21,841. And when I sold the stock, I got $26,895. So there was a nice gain of $5,000. The return over the course of that 4 or 5 months was 23%. When I annualize the return, it really computes to 69%, which is a very good return. And I'm really glad that I invested in Qualcomm. Now that the stock price has really come down, I think it provides an opportunity to get back into this quality company. I'll be doing so. So I hope you found my video interesting, and I really appreciate you watching. Keep in mind, I'm just an independent investor. Just share my experience on YouTube and other platforms. I don't recommend you buy, hold, or sell Qualcomm. Please make your decisions on your investments independent of this video. Thank you for watching. Good luck investing in 2024.